So today, I thought we would take a look at S&P 500 and what's happening in the marketplace. A bunch of you have been asking me to review this in the comments section, so I want to give it my best shot. Obviously, the equity markets today aren't acting as one would expect given some of the news. And, when you kind of look at the markets themselves, there's a lot of things going on here, and they're not just necessarily due to the fundamentals or what's necessarily happening in bonds or the dollar. Typically, when I think about the market, I try to think about the interrelationships, meaning like if I think rates are going to go higher, how do equities typically respond when rates go up? Or if the dollar is going to strengthen, how does that necessarily respond to the S&P? And then I try to look at the technicals, understand what's happening there, look at how the options market's positioned, and try to make an educated decision. As I was explaining to my subscriber base over the last couple of days, is that it's always about kind of shifting the odds to what I think are most favorable to me in terms of the outcome and what's most likely to happen. And that doesn't always mean that you're going to be right. Again, I don't have any special powers. Nobody really does when it comes to predicting the equity market or anything in the asset world as it is because we know that headlines move the news. I mean, every day they come out and say trade deals are going well, and you get a little bit of a blip in the equity market, or they say that they expect trade deals to be signed soon, and the equity market does whatever. So there's a lot of algorithmic stuff going on. But if we just more broadly look at what's happening in the S&P at this moment, I think it's very clear to me, at least, is that there is a rising wedge type formation in the market currently, and you can see that how I have that labeled at this point. I think more importantly, though, when you look at where we are right now, we're kind of at a point where something is going to give, and it probably should be giving fairly soon, at least in terms of how this is shaping up. What I'm looking for is a little bit more detail, though, than just looking at a rising wedge pattern in the S&P, because clearly, while technicals can tell us what's likely to happen, it's not going to be right all the time. So when we look at things like the 10-day exponential moving average, you can see we're still trading above that. I would like to see the equity market really fall below the 10-day exponential moving average to give me more confidence that there is going to be a change in trend here to something that looks lower. And the reason why I'm also looking for things when it comes to lower is when you look at realized volatility. I had ChatGTP help me write out a Pine script for TradingView, so you're actually able to calculate a lot of these fancy sort of indicators that you hear a lot about, like realized volatility, implied correlation, realized correlations, just using data on TradingView, just using ChatGTP helping you write a Pine script, meaning like I know what the outputs I'm looking for are, so that obviously helps me. You really need to know what you're looking for to make sure, though, that you're getting the right information. So what I tend to look at are the 1-month implied correlation index, which again gives you a sense of what the correlations are in the marketplace. And typically, when correlations are rising, you expect S&P 500 to be trading lower. This is another reason why I think the equity market is likely to be heading down from here, and why I think the rising wedge pattern may prove out to be correct. When you look at implied correlations, the 1-month implied correlation index has actually been starting to rise, and historically you can see when implied correlations rise, equity market moves down. So the implied correlation index on the 1-month kind is starting to move higher, and the 3-month implied correlation index also starting to move higher. What we're looking at on this screen, though, particularly, is the 3-month implied correlation index in red. And what I've done in green is create a proxy for 3-month realized correlation. And basically what I did was I took the top 25 stocks in the index and created this realized correlation index. And what's important to note here is that implied correlation should be leading realized correlation, meaning that if implied correlation is coming down, you would therefore expect realized correlations to come down as well. The interesting thing, and you can see that really specifically if you go back to 2018, implied correlations came down, implied correlations and realized correlations came down. Here you can see implied correlations rise, realized correlations rise, they came down. But more interestingly here is you're seeing implied correlations coming down, but you're seeing realized correlations actually still rising. And that's a little bit of an oddity. And that's something that makes me wonder as to specifically why is that divergence occurring, And more importantly, are implied correlations off base? Is the market assuming that realized correlation is going to come down? And it's not. And that's really a big tell, because if this is bottoming out at these lower levels, then that would make me believe that implied correlations are likely to head higher. And if implied correlations head higher, that would also kind of go with what we're seeing in the rising wedge pattern, which is some sort of market reversal should be happening. The other thing we're looking at here on the bottom screen is 10-day and 21-day realized volatility levels. And what you can see is that 10-day realized volatility has really fallen back to the very low end of the range. In fact, you can see here at 6.3. That's really, again, sort of the low end of the range. You don't typically see realized correlations realized volatility getting that much lower. And what this implies is when realized volatility gets this low, it implies that there can't really be a lot of movement in the S&P 500 without realized volatility going higher. And so if you take realized volatility and you divide it by 16, that essentially gives you what the daily range can be in the S&P 500. So in this case, if you take 6.8 and divide it by 16, it's telling you that the S&P 500 can't move more than roughly 40 basis points up or 40 basis points down without causing realized volatility to rise. So right now, for example, the S&P is up about 30 basis points today. And that means that if we start going up even further on the day, you will start seeing 10-day realized volatility rising. Now, why is that important? Because depending on how high realized volatility gets, let's say it gets back above 11, you're going to then begin to see 21-day realized volatility rise. And if realized volatility is rising, one would then expect the VIX index to rise. And sure enough, you have that rising today as well. And typically, before you actually see the VIX begin to rise, you see the volatility of the VIX rising, and that's the VVIX, right? So once you start getting to a point in the marketplace where realized volatility is very low, which is where we are right now, that's kind of a warning sign that the market is getting to a topping point. And so you wait until you get some form of confirmation in something like the VVIX that start moving up to really start telling you that maybe we're getting to some sort of point where the market should be starting to roll over. And once you start seeing the volatility of the VIX rolling up, you then see the VIX moving up, and then you would then also expect to see the S&P 500 come down. And so what this is all sort of implying to me is when you look at where volatility is and when you look at correlations are and you look at the technical patterns in the S&P, you now have a really good reason to think that maybe we're looking at a scenario where the S&P 500 could actually trade lower here and significantly lower, just because we've had such a big move up and you haven't really seen much of a pullback at all really since I would say 5100 on April 22nd. And so the way I'm sort of thinking about this, right, is that if you have a rising wedge pattern, typically a rising wedge pattern will retrace back to the origin of the wedge, which comes at around 57.70. But really right below that, you have this giant gap that was created following that China trade announcement. And so it's quite possible that we could be looking at a reversal to about 56.70 or so in the S&P, which really isn't such a big deal. But that's what I'm kind of thinking about, at this point, which is about a 6% decline or so. And then, of course, my view is then you kind of take it from there. But at least when you look at it from a volatility standpoint and applied correlation standpoint, and then you add the technical component to it, you're kind of looking at a scenario right now where I think the S&P is probably due for some sort of pullback. You're also seeing rates coming down because you're starting to get some pretty weak economic data, although you can see the 10-year yield right now has actually traced out what I think is a bull flag. And you can see that we've come down to this flag and tested it, and at least as of this point, it is holding. And so that's something we'll need to keep an eye on. And obviously the dollar is really breaking down a significant way as well. Let me just get rid of those things. And you can see that here's our descending triangle. That clearly broke. We're testing right now 97.5 on the dollar index. I think there's good reason to think that maybe the dollar goes all the way back to 95 or so. because you're certainly seeing, breakouts in the euro. You're seeing that happening. You could certainly see that there's room to maybe rise up to this 117, maybe even 119 area. And right now we're just kind of waiting to see what's going to happen with the yen here, because I think the yen, if we can get below 141, 142, you're talking about moving back into maybe below 140. So when you kind of look at the idea of where the markets are right now, weaker dollar would certainly suggest two things, right? Recessionary risks are building, or stagflation type risks. And if rates, depending on how those kind of formulate and move forward, rising rates, weaker dollar makes you think more stagflation. Falling rates, weaker dollar makes you think more recession. I don't really think the market has fully come to grips of which way we're actually heading in terms of where rates are going. I will add one other thing, is that if you look at where the Fed funds rates are, there's still a reason to think that rates are going to go higher. And again, the reasoning really here, and what I've been talking a lot about, is that if Fed funds are going to settle out somewhere around 3%, and we're talking about, rates kind of bottoming, if you kind of think about where a 30-year minus a 3-month rate typically peaks, and you kind of think about this cycle, assuming a 3-month is going to be close to the Fed funds rate, you're talking about usually the 30 you're trading roughly 400 basis points above Fed funds, or in this case above a 3-month. And if the Fed funds is going to bottom out somewhere around 3%, and we get a 3-month bill somewhere around 3%, one would expect that you'd see a 30 or maybe get to 6.5%. Maybe even go further than that, depending upon how steep the curve ultimately gets and how far down the 3-month goes. I mean, even if the 3-month gets to 2% and we have a typical type of cycle, and then you add 4 basis points onto 2%, you're talking about a 30-year still at 6%. So there's a good possibility here that rates are still going higher, even though the economic outlook isn't looking particularly strong at the moment, or there's a lot of confusion around it. Because, again, it's going to really be based off of where the market thinks Fed funds is settling. If the market really believes that Fed funds is settling somewhere around 3%, then the 30-year and the 10-year, in my opinion, still have much further to climb. And that's going to also probably be a little bit of a headwind for stocks over the longer term. But at least over the very short term, I think you could still have a lot of variability in rates. I think you could probably see the dollar continue to weaken. And if you just purely look at the technical setup in the S&P, and you just look at where volatility and implieds are, you kind of get the sense that we're due for a pullback here, and probably something back into the 5750s, maybe the 5670 area, I think, before this all settles out. But that, again, I don't have special powers, and I'm just trying to give you what I'm looking at, and we'll see how things evolve from there. And I'll be back over the weekend with our typically weekend update. I've been super busy with just trying to take care of a lot of different things here on my end, and I haven't had the chance to really commit to YouTube as I've had in the past. So hopefully, as those things start settling down, I'll be able to return to a better schedule. And I apologize to those of you that have been looking for a market update and I haven't been able to deliver one. If in the future you're kind of looking for one, if you come together and you leave some comments and let me know, it's certainly helpful. Please also remember to check out my blog section that I post every day on the comment board. And please remember to subscribe to this channel, share it with your friends. Again, the more followers we get here, the more time I'm going to obviously be able to dedicate to the space, because, again, I'm really trying to get in front of you and to try to give you information to the best that I can. Anyway, have a great rest of your day, and we'll see you later. Bye.